If it's just, I want to be worth this much money or I want to have this much cash flow, but there's nothing more behind it, then I think that's not very motivating.
What's up, everybody? This is a 0 to 100 podcast where we talk about time freedom through cash flow real estate. And that's a really important topic because time freedom gives you all the other things, right? The time to build relationships, to get healthy, to travel, hang out with your kids, take care of your parents, whatever that is. And so week after week about using real estate to create cash flow and cash flow create time to do the things that are most important in your life. Part of that is we get to have awesome guests on the show. This week we have Phil Moeller. I'm going to give a quick introduction to Phil, and then we're going to dive into his story. So Phil began a Fortune 150 company where he excelled in executive management by leading global teams. Since 2013, Phil has channeled his expertise into real estate, founding Moeller Real Estate and acquiring and managing over 600 units through more than 50 transactions involving single family and multifamily properties. His mission is to inspire and educate others to live their God-given purpose. Together, Phil and his wife, Marcia, I think I said that right?
Marcia.
All right. His wife are raising their 5 children, focusing on teaching them the same core values that have shaped their lives. They cherish creating memories through family adventures and travel, made possible by their decision to step out of their comfort zones and pursue financial independence. Their shared vision is to inspire others to live their purpose and passion and gaining freedom and flexibility to build a fulfilling life. All right. I apologize to your wife if she's listening.
She won't listen. It's all good, man. She'll maybe listen to you guys if you're good. She won't listen to me, so it's all good.
Okay. All right. So, well, hey, welcome to the show. Thanks for joining us. Where are you calling in from today, Phil?
Yeah, I'm in Ohio. First of all, thanks for the nice introduction. That all sounded very, very good. It made me sound like I did something or I know something. So, but I'm calling in from north of Dayton, Ohio, and I'm really looking forward to the discussion, guys.
Yeah, welcome to the show, man. We're, whenever we do an intro and it's purpose and freedom and those types of things, we get pretty jazzed because this is why people tune into us. We have I think 3 people. If your wife, if she logs in, that'll be.
I'll get my kids on. I got a bunch of siblings too.
Oh, you have 5. So, you have 5 children, so that would double our listenership.
They won't listen to me either. So you guys are in trouble. You're going down the wrong. You got the wrong guy for that.
Did I hear that right? So you did you say you founded or you started with a Fortune 150 company?
I started with, a little bit of my backstory. I think first I grew up in an entrepreneurial family, big family, one of 7 kids. My dad and his brother started a trucking company. A lot of my really young childhood, the office was in our house. Can you imagine that with 6 boys and my sister? So just trying to make phone calls or do business. I don't remember it, but I know it was ingrained in me, if that makes sense. They moved to an office when I was 5, 8 years old, something like that. But anyway, it was ingrained in me. And then I went to school for engineering, went into the corporate world. I did that for a long time, about 15 years in total. But during that time, I was also building a real estate portfolio. So, and then in the corporate world, I gained a lot of experience. And I would say anyone that's doing anything, if they want to do real estate to get freedom, that doesn't mean don't take advantage of what you're doing and learn as much as you can while you're doing that. And I learned a lot about business, finance, project management, business plans, all kinds of things. And that leadership was a big one, a lot of training and lessons in leadership. So I don't regret it, but I'm also excited about where I'm at right now for sure.
So were most of your roles sort of in the project management space? Is that right?
Yeah, I did engineering for I think 3 years. And then I went into project management, product management, and then senior levels of product management. So I led product managers. Eventually I was in a role where I led a product management team. We also then created a program management group. Man, I haven't talked about this in a while. Product marketing. And then I also had a team of developers that were some local in the US and some overseas that I led that. And honestly, we were talking about IT a little bit beforehand. I don't know software. I don't know IT and development. But it was really about putting the right people in the right seats and trying to be a good leader for them and just sharing the vision.
Mitch, he said, so he was a product manager, which is a lot cooler than what you were. You were a lowly project manager.
I thought he said project manager as well, but maybe I heard him wrong.
I always wanted to be, I want to go with Travis on this one. We actually had a program management function, and then we split them into product managers and program managers. my heart is really, really with the product managers on this
Oh
one,
no,
guys.
I trust me, I don't defend project management. It was horrible.
You know what? You learn so much though. You influence without power. It is in you're dealing with operations, sales, marketing, finance. I mean, you name it. You're dealing with all the different groups.
And whenever you get into real estate, you hire people for all of that stuff. Project manager, value add property, project manager. Phil, you said that you were working in the corporate world and you were starting to invest on the side. Did I catch that right?
Yeah. So in 2011, we had our first daughter. And again, all the entrepreneurial bug, kind of what if, or just curiosity. In addition, started educating myself on real estate. And our first goal, our first purpose, if you will, behind real estate. And I loved how you did the introduction, like gain freedom, gain time, so you can spend time on what's really important to you, whether that's your health, your family, faith, whatever it might be. And being in alignment across the different areas of life, I think is really important. But my first goal was, my wife, Marcia, was a hairstylist, and we wanted to start reducing her hours. So if that's, hey, can we cut out Thursday evenings or Saturday mornings or Tuesday evenings? And we kind of started peeling those away as we added single family homes. So we bought our first single family property in 2013. I mentioned, by the way, I was an engineer by trade, so very analytical, over analysis. So I really needed to educate myself, get clear on my purpose, and network and associate with others to give me the courage to act. It probably took me 2 years longer than what it really should have to finally pull the trigger. And I do tell people a lot, especially if there's, people that are either looking to make the next step, whether that's their first investment or their first time to go from a 1 unit to a 4 unit or a 4 unit to a 16, is just really get a good understanding of the upside and the risk and the opportunity. And the risk, a lot of times we can assess, which is a lot of time, it might be financial risk. Maybe it's a little bit more time that it takes. But the upside, I don't think a lot of times we really understand what that can be, because I didn't picture in 2013 when I was making a decision on that first house that I'd be sitting here today where I'm at, right? I just pictured the upside might be $200 of cash flow and maybe Thursday evenings for my wife to be able to be at home. That was in my head, the upside. But the upside a lot of times are the lessons we learn, the confidence we gain by taking the action. And from that, then I went, and all of a sudden, okay, I have the confidence, I had the conviction, the numbers make sense. I'm going to go buy another one and another one and another one, and we get rolling, right? So I think there's just this, the other thing I say is fear, regret, not failure. I procrastinated for a long time, but I said, am I really going to sit here in 20, 30, 40 years from now and say, man, I wish I would have tried this? And it finally got me over the hump to take the risk, if you will, for that first property. And we were kind of running from there. It was for me.
Thought of laying on your deathbed or looking back going, dude, like, we should have done that. 2011, would you say 2011?
I finally pulled the trigger to buy my first rental house in 2013.
Not a bad year to start buying.
Yeah, no kidding. Well, going back to what you said, Phil, the upside, it's tough because we also look at a property sort of in a tunnel or like we silo a property out. In other words, when I look at my journey, my properties that I buy today and the wealth that I've grown today is based on those first small single family homes. Like a $95,000 home in Wisconsin or in Minnesota, like built my confidence to buy a big RV park, right? So I didn't factor in, I think that's where you're going with that. There's this intangible mindset upside that's like immeasurable. We can't really measure it, but it's like a real thing. It builds momentum, it builds confidence, experience to go do these things today that I could have never envisioned. So I love that you said that because it's cash flow. Yeah, it's appreciation, but like there's this thing that we can't measure that's really, really important. And that is building your foundation for experience and for further scale.
100%.
It could be a base hit, but from a mindset perspective, it's a home run.
Yeah, and we can educate ourselves and associate with others. We can do that till we're blue in the face. But the mindset growth from action, I think, is so critical, right? And it just piles on to, the things we do to educate ourselves, whether that's listen to pod. Those things are all important. But when we take action, we combine them. If we build our mindset with action, I think it can be profound.
And no offense against engineers, because like one of my best friends is an engineer. Now you mentioned someone else, don't get all jealous on me. So kudos to you, because some of the worst action takers I've met are engineers because they get into analyst paralysis. And I had this buddy I'm talking about, where, I think, back in 2009, I found a nice little 5-plex, had no idea what I was doing. But I was like, he had money, he had a good income. I'm like, let's do this 5-plex together. And he evaluated till the cows came home, and then it never did that or did anything ever. And so he still has a house, which is great. Now I'm at several hundred units later, and the guy still hasn't done anything. And so again, when you look back, maybe that 5-plex was just a base hit. Maybe it was a double, but man, back then it would have been a double. Now it's a home run. Now that thing's like quadrupled in value.
I think it's just so important to get clarity on why you're doing it. Again, just have the purpose behind why you want to pull the trigger. That'll give you more courage, educate yourself, associate with others, and just, again, understand what is the real risk of that? What is the downside? And I say, fear, regret, not failure. What will you wish you had done 10 years ago today? And you just got to pull the trigger.
I'll put it as bad. The downside is not as bad as, like, Mitch says this all the time. Like, you're not going to end up, like begging for gas on an on-ramp, or eating rotten food under the bridge. Like, the downside is you probably screw up, lose some money. Maybe you still have an asset you can sell or hold for a while until things right themselves, and you go get a job and and you go back to your salary. So it's usually not as doomsday as people often think it is.
I've heard it. Maybe other people have said it. A lot of times the downside is you would have to come back to doing what you're already doing.
Well, Phil, go back for a second, because I know sometimes we gloss over that first deal. We just keep rolling. But I want to go back and talk about mindset just a little bit, because you're working a job. I think, did you say you had your first child, or your first child was on the way?
Our daughter was born in 2011, and we pulled the trigger on our first house in 2013. She was about 2 years old.
Okay, so you're working, you've got your wife, you've got this little kid, a growing family. Obviously, you want to grow more, I'm assuming, since you have 5 children now. But like, where was your head? Were you scared once you did pull that trigger? You inked the deal. Were you nervous? Were you shaking in your boots? Were you like, what did I do? Or was it like you analyzed it enough to know it's a great deal? Like, I'm just saying this because a lot of our listeners haven't pulled the trigger. So where was your head, and how'd you push through those limitations?
Yeah, I was fearful. I remember, again, going back to the analysis paralysis, I remember looking at, well, if it's vacant for a month or two, the utility cost is going to be like a couple $100, and then that adds to it. But really, as you said, Travis, what is really going to happen here? And I think we can better understand the downside than the upside, but we focus in on that so much. So I was very focused on the downside. Hey, what if the market changes? Will I lose, a couple $1,000, $5,000? Will I be negative on equity because of it? It was probably a month, I don't know, 2 to 4 weeks after I got it. It was rented, stabilized. By the way, even the anxiety around how do you close a deal? What does that process look like? Anytime you're doing anything new, it's like, am I going to mess this up? Am I going to not have the right insurance? Whatever it might be. When there's uncertainty, what I do and what I've done in the past is I create every single problem that might happen in my head before, and I try to solve it, which isn't a healthy thing to do, but it's just how I did it there. It's how I eventually, when I left my job, I created every potential issue in my head. And I think the main thing to realize is, yes, issues will happen. They probably won't be as bad as what you anticipated, but you will also have time to fix those problems. Like it's not like the problem comes and it has to be solved the second it happens. You can problem solve once it happens. So just getting out of my own head and pulling the trigger, and very quickly thereafter, I gained the confidence. And as I said, the negative of being an engineer was overanalysis. The positive was, after a month or two, when we started to see how it worked, principal, interest, cash flow, everything that was happening. Oh, this works. This makes sense. I'm going to go do this again.
Hey, Phil, question for you. Well, first of all, I love that you said sometimes you just got to get going and iterate. Like, problems come, you problem solve. Generally, the problem you solve turns into maybe a process that you can implement going forward. So problem solving, like, problems are good. Like, people look at problems as bad, but problems can be great. Like, some of the most innovative things in life comes out of solving for problems, right? So I think we say, get the airplane in the air and start building the wings a little bit. Sometimes it can be super cowboy. Some people are just like, I'm going to raise a bunch of money and I have no idea what I'm doing. I'm going to go buy this property and I don't understand underwriting, but let's go. And like, that's not good. But also like, okay, I've got my guardrails set up. I understand the downside. I have a relative understanding of the upside. Let's just get this airplane in the air and we'll iterate. I'm curious, going back to my question, you were working and you said, I want to start leveraging real estate to replace Thursday night or Saturday morning for my wife. number one, I love that because a lot of times we think it's 1 or 0, right? It's you hit R1 and you retire and you have enough passive income. R1, we call retirement number 1, which is where you do generate enough passive income to cover your lifestyle and living expenses. But we often talk about it on this show and in our tribe like it's an event. But I think also it can be a process. Like, I'm going to retire my wife. I'm going to retire her half time. I'm going to retire 3/4 of the time. I'm going to retire full time. Then I'm going to start chipping away at myself. I know Justin Donald was on our podcast who wrote an amazing book, and that was his goal. It's like, I'm going to chip away at this. So R1 can be a several year process. But my question to you is, why real estate? Right? Because back in those days, real estate was sort of had a bad name. Like, there was a lot of people when you started buying houses that got their ass kicked, right? I mean, me included. Like, real estate, like, never. A lot of people said they tried it, never ever. They tried to flip a house, they tried to do a spec house, and maybe they over leveraged, zero money down on a variable rate loan. That didn't work. Never again real estate. But you're saying real estate was your vehicle. Why not Amway? Why not something else that where you wanted to go?
So first of all, from '05 to 2011, 2013, like, I was wondering about other things, trying some new things, like trying some different things. And I just kept coming back to, man, but everyone that's really done it or grew wealth, like, real estate was the vehicle that worked for so many different people. So I was like, I have to try this. And I will say that even though I procrastinated a lot, when I ran the numbers and just educated myself, which it took a while, but when I did, it's like, this makes a lot of sense, right? And I say that my knowledge and comprehension of it after I started in real estate was way, way better, but it still just made more sense than a lot of the other things maybe I had looked at or tried.
Yeah. Plus, it's easier to buy real estate than try and get your friends to sell Amway for you.
And I mean, again, just your listeners have probably heard this, but the 5 ways to make money in real estate are just very, very real and profound and can stack up. Again, after the first one, especially, I started to understand those. But I mean, the cash flow is wonderful, principal payoff, forced appreciation, market appreciation, and the tax benefits I really didn't understand until probably a couple years later. I mean, probably 2, 3, 4 years into my real estate when I really understood how it can help us with taxes.
It's a big deal. I love that you listed those. So, Phil, I want to go back then. You bought your first property. You start to see the numbers. You've got your engineering mind wrapping around this going, wait, this is real. Like, we can do this. This actually works.
Dig into that deal though. Bro, I want to just gloss over that either because people go, oh, you bought a house? Like, was it like it's owner contract? Where did you find it? You don't have to like dig into the ultra details here, but again, I think we sometimes gloss over that.
I'll do my best to combine, I think, what were the 2 questions on that first deal and kind of how it evolved from there. So, single family house, I think it was probably listed for $70,000. I got it for, I think, $66,000. I almost lost it because I was trying to negotiate so hard, just to almost like convince myself I'm a good negotiator, which also probably wasn't great for building the relationships with the real estate agents, which is really, really important when you're in that phase because they might not even believe you that you're actually going to close a deal anyway. So I got it for, I think, $66,000, about lost it for $1,000, which again, if you think about the risk of that and the perspective, like, it's ridiculous, really. And then we actually started, and where I worked, there was like a co-op or internship program. And for the first year, we rented it out by the room, which boosted the cash flow. But I also realized while I was doing that, that was quite a bit more work, more turnover, more headaches. And I learned the real estate market well enough to know, okay, this still would cash flow without doing that if I just rent it out as a house. Found it on the market with a real estate agent. Again, I had been talking to different agents for probably 2 years, I would guess, and hadn't pulled the trigger. So I was getting close to where they were going to give up on me. Some of them probably did during that time period. So pretty basic, but yeah, $66,000. I mean, north of Dayton, Ohio, we're not finding those prices. Or
how much did you rent it out for? What was your gross rent on that?
I think originally with co-ops, it was probably like $900, but the market rent was like $750. So then we transitioned from the renting it to co-ops or interns to just renting it to a family or whatever for
conventional financing, like 20% down type of just basic plain Jane.
Yep. And the first couple deals, single family deals we did was like, 30-year fixed financing with the local bank. But I think it was deal 5 or 6 or so. Then we went to commercial loan structure with local banks from kind of traditional conventional financing.
Phil, do you still own that property today?
We do not.
Yeah, I was just curious what that looked like when you sold it.
Oh man. Probably all of 150.
Okay. And you think about that $1,000, you almost lost the deal over. I also see people do that too. They try and put their negotiating hat on, and they feel like negotiating is I have to win and then you have to lose.
Yeah.
And we always need like win-win. Like, what does the seller want? How can the seller win? How can the broker win? How can the tenants win? How can you win? But I do see people, my wife did that one time too. We were selling a house or a condo, and she got so upset about this inspection that came back, and they were asking for like $750. And she wanted to almost walk on the deal. I'm like, in hindsight, we sold that condo for the most that ever any condo had sold in that complex. And I'm like, just made the $750, take the money off the table.
Yeah. Well, I think a lot of times we let our emotions guide our decision making. So I want to come back to Mitchell's question too. Before I do, sorry, but you also pointed out, like, if that sold or if it was worth $150,000, like, okay, you tripled your money, but leverage appreciation is the other important thing, because we would have put down probably $15,000 or so. So we borrowed $40K. So if we put 15 and it was worth 150, right? It went up at the time. If we owed 40 and it was worth 150 after fees, let's just say we cashed out 100, we would have 6x our money, because with leverage, as long as there's still cash flow and you're smart about it, you can compound your returns. It's not just, if the market grows at 3% or 5%, but you have, 4-to-1 leverage when you're 25% down, you're multiplying that return by 4. So if the market grows at 5%, your return on your investment is really 20%. So leverage appreciation, I think, is important. So we learned a lot. And then from there, we gained the confidence, as we talked about. And then 4 months later, we bought another deal. And 4 months later, we bought another deal. And 3 months later, we bought another deal. And I think it was the third or fourth deal where there was a sheriff's sale. We got in before it went to the steps, if you will. We looked at it. We offered cash with our home equity line of credit. And this is where, instead of bringing our own money down, which we did in the first two, we did the burst strategy, where we bought it with a line of credit. I think we bought this one for $52K. We put $10K into it. So we have $62 into this thing. We go to the bank, do a commercial loan on it. It appraises at $80. We borrow the $62. We have zero cash into it. And that's when I'm like, okay, this now doesn't require all of my cash every single time, where that's going to be the metering device of how fast we can go. I can do a little bit of cash from my salary and income in addition to building equity and the burst strategy as we find deals there. So, and then we bought, for 4 years, we bought single family homes and duplexes. We got up to, I think, 25 or so before 2017 is when we shifted to multifamily.
When did your wife step away? Was it after that first couple of them that you kind of saw some momentum? When did she start to step away from?
I think it was like 2016. And then she was helping manage our properties. And then there was a pivot where in 2017, she's managing 25 doors. We're doing it in-house. She's dealing with and I think when you're buying single family, when you're in the acquisitions phase, you're dealing with more newer tenants. Like it's less stable. Whereas now we still have, I think, 10 or 11 doors left of the single family. The other stuff we've rolled into multifamily. But those residents have been there for a long time. So there's just almost no issues with them. They're just really, really stable. But back then, there were more issues. There were more maintenance issues. And she said something like, I didn't sign up for this. And I had to make the decision in 2017. Do I sell them? Do we just say, hey, I'm just going to go the corporate path? Like I know I can do that. I can be successful there. I can make a really good living. Or do we shift where we can go to multifamily and leverage scale and really remove her from her second career, which was property management. So
Phil, just to recap, for those of you people that are listening that do have a good W-2 job, by the way, that's a great way to get into real estate, because you have a good income and a good W-2 pay stub. Like these conventional lenders, when you're buying like 4 units or smaller, that's like all they care about. They're like, you got a job? Sweet. Here's a bunch of money, and here's some of the best terms: 30-year amortization, 30-year notes. And so that's, by the way, that's a great way to get into the deal. By the way, just to also, BRRRR stands for, buy, rehab, rent, refinance, repeat. Did I say that right?
I think.
Great. But basically, we talk about the velocity of capital. You started out by putting down payments but then you can start doing it faster and faster because you're basically borrowing, you're building equity in a portfolio through appreciation. You tap that equity, go buy more units, right? So it's sort of like that, we call that the velocity of capital. So I guess my question to you is, if someone's listening going, well, that's great, Phil, I don't have an engineering degree. I don't have a nice 6-figure salary or whatever that is. How could I do that? How could I go buy my first single family house? Because I know, how could I buy my first duplex? How could I do that without having a high income job?
Yeah, I think 3 approaches come to mind. I don't know, I'm sure I'm missing some, but I would say if you can muster up the capital just to get the down payment, that's obviously one. If you have equity in your house where you could use a line of credit in your, like the house that you live in, that's an option where you can leverage that to buy with cash and then refinance it with a bank. By the way, banks, as you said, they're all about controlling or protecting their risk, and they like to do that with security, whether that's in collateral of a house or of income, so that income does matter and helps with banks a lot. But the third way you could start is, actually there's a couple. I mean, hard money lending. Of course, there's all kind of hard money lenders out there. You'll pay probably, a higher interest rate to get into the deal. But I know a 20-year-old guy, he's about to graduate here in the next couple months from college, and he just put a duplex in contract using hard money lending for that deal. And then once he gets it fixed up and stuff, he's going to go to a bank and refinance it. So hard money lenders are out there. Or if you have trust, I think trust is built in 3 different ways: character, competence, and connection. You probably don't have all the competence around real estate, but if you have character and connection with someone that has money, maybe you can get into it by either borrowing from them with debt or sharing equity with them. So other people's money is certainly a way to get started as well.
I like that: character, competent, and connection.
Yep.
That's cool. I'm just writing that down. So Mitch then doesn't have the character. He's half competent. So, but he knows a lot of people. So
I appreciate you, Trev. What a kind man you are.
Such a kind man.
See, Gabe's not here to tell us to behave. So
is he the mediator?
And I was like, okay, back. But now he's like, back to post right.
I'll try to take the role.
Yeah. Help us out, Phil, because this could go sideways.
I might be more of an instigator than a mediator, so I'm just warning you. So this might be fun.
Let's talk about your mindset. The mindset I'm going to go back to my corporate job, or I'm going to cash out these single families, and I'm going to roll to single family. And so like you decided not to obviously go back to your corporate job. Why that? And then how did you leverage what you had built up to that point to pivot into multifamily? Because this really is the story of 4 greenhouses and a red hotel, right? I mean, we're all playing kind of real life Monopoly here.
Yeah, so definitely a fork in the road and a decision to make. But it went back to the same. I had the same mindset around this, but it had grown over the course of 4 years, I think, through education and just trying to network with others and build my mindset. And listening, educating myself on multifamily. I had started that process. I had listened to different podcasts where you just hear people make this transition. And so I had been thinking about it a little bit. I'm like, okay, this is inevitably the time to do it. And it was just, I was still in the corporate world at the time, but was I going to just sell our houses and commit to doing that for the long term? And it went back to the underlying, what if this doesn't work, or what if it does work, or what will I regret if I don't do this? And I had enough of an itch to move in that direction. So really started looking at deals, going to real estate investment association meetings, trying to just build our network around multifamily, because a lot of it was more local and, smaller town, single family agents, whatever it might be. So we went to a real estate investment association meeting. I don't know, we didn't go to that many. And there's a guy that raises his hand. He's like, hey, I have a deal, but they couldn't get financing. So it was a 48 unit property. Myself and another guy that went there, my now business partner, started talking to this guy. He couldn't get the financing for the deal. It was a great deal. My gosh, we bought 48 units for, I think, it was ridiculous, $800K. I mean, like $17,000 a door. But it also probably should have been a sign of what kind of property it was and what kind of resident base it had, which wasn't very good. It was like 65% occupied, I think, at the time. We were all 3 single family guys. We're getting to know this guy because we just met him at the real estate association, but we were all single family guys. So we're making progress. We bring in really strong financing, local bank debt that also helped fund the CapEx that we needed. So we only had to bring down 80% of the total project cost, so it was really favorable financing. They probably gave that to us because my primary business partner and I both had really good corporate careers and corporate jobs where we could afford the debt if, even if the thing didn't cash flow at all. But we decided we need to bring in a fourth partner that has multifamily experience, which is exactly what we did. So we brought in a fourth guy, gave him a good deal, just a simple equity split relative to capital. And he kind of was our mentor and guide on that first deal. So we closed on that and had a third-party management company run that for 13 months. And then we sold that at that time. So, and then to go back to your question on this transition too, not on that deal, but over the course of time, we started selling a single family and buying a multifamily, or selling 2 single families and buying a multifamily. And the nature of how we did that was either when we bought, we do a cost segregation study to offset the gains, or we would 1031, even a couple of them, we did a 1031 out of our separate entities into like a TIC structure, tenants in common, which people don't need to remember all that. But there's ways to do these things if you put yourself around smart people, 1031 companies, people that have expertise in these areas. And we just started rolling and, as you said, playing the game of Monopoly a little bit, where we took the little greenhouses and rolled them to the red apartment buildings.
So Phil, what is that? You bought that multifamily for $800. How much did you put into it? How much did you sell it for? Dive into that deal a little bit more, because we dove into a single family. Dive into that deal, maybe the numbers behind that.
Yeah, we bought it for $680. We put $120 into it, a little bit of roof work, windows. I think I said it wrong, so that was on me. But roofs, blacktop, unit improvements. So we had $800K into it. I think we sold for 1.4 13 months later. So we had a management company running it. Honestly, we only had it maybe 80% occupied. I would say 2 things. One, it was probably a D area, not a C, but a D area. Like, it wasn't a great, the property had good bones, but it wasn't in a good area and did not have a good resident base. We probably could have made way more money on it if we really, really would have put our time and effort and really turned it around. Our management company honestly probably didn't do a great job. 48 units is kind of a clunky size, honestly. But 13 months later, we sold it. And then because of how we had it structured, my partner and I, the primary partner that I went in, like we went to this meeting together. We took the proceeds from that sale and we rolled that into our first, a 72 unit that then just him and I owned, and we still own that one today. And that, we bought it in, that one was then 2018. So if 7 years of just rent growth and appreciation has obviously been in our favor.
Did you sell that first one just because it was a D area, the tenant base, management issues?
Yeah.
In the 72 unit that you rolled into, is that B class, A class, C plus? Like, what is that?
We weren't going to go manage it ourselves. We were going to step in, and it was not, the area really wasn't going to change. Actually, the fourth partner that we brought in, he had just sold a lot of his portfolio to a buyer out of state. And so after he closed that, he's like, hey guys, would you entertain selling this just 13 months in? And we're like, yeah, this makes a lot of sense. The other thing I would say is, in the meantime, we had bought, that was 13 months, but in the middle of that, we bought a 16 unit property, just the one business partner and I, and we really learned multifamily, and we just, all those things, as we said earlier, gave us the knowledge and confidence that, okay, yeah, multifamily makes a lot of sense. We really understood the value add component after the first several months, which gave us, even more conviction that this was the direction we wanted to go.
Makes sense. So what are you buying today? What's your target? Well, maybe talk about what your portfolio looks like, but also like, what do you focus on today? Where are you focused? What assets are you buying?
Yeah. So, and to go back, so that first one was probably a D property. The stuff we were buying in 2017, 2018, 2019 was probably C class. We actually bought a property in 2019 that was maybe low C class, but we really, really did a heavy lift value add that we ran ourselves, a lot of that ourselves. So our portfolio consists of C class and B class, and we're really transitioning to try to focus on buying more B class product. If it's 90s construction, 2000s construction, we really like that type of product right now. The resident base is a little easier to manage, lower maintenance costs, lower turnover. There's a lot of benefits to that. I think it's more recession proof. B class is a good spot to be. And then from a portfolio size perspective, last year we bought a 100 unit, a 30 unit, and a 70 unit. So not to say like we're just targeting specific ones, but if we can be in a 60 to 70 mile radius of where we're at, we actually now have an internal management team that's running this stuff too, because we've brought in investor capital. So to have that control and have much more influence on the outcome, I think is important. But really our target is B class. We'd like to be in the 100 unit range, but we also will pick up other things if they make a lot of sense.
Where are these located? Are they on Midwest? Are they close to you? Sounds like, because you get some economies of scale, your internal management function.
We do. So we're just in a few different small towns, north side of Dayton and north of Dayton, up to 60, 70, 80 miles north of Dayton. Actually, strategically, we're trying to spread out a little bit, maybe touch at the outskirts of Columbus, maybe a little bit of Cincinnati, get to those markets. We'll probably start in those markets with a smaller deal, just to really get our flag planted, if you will, before we really go into larger projects in those markets. But we just need to, expose ourselves to some of these bigger markets if we really want to continue to grow. So that's a long term. We're trying to set ourselves up to learn these markets better for the longer term. And like Columbus, we went to school there, my operations manager and I, so we know those markets and submarkets pretty well.
So Phil, for our future syndicators or current syndicators, will you walk through maybe just your average sort of like structure with a syndication deal? What does that look like? Equities, preferred returns, that kind of stuff.
So before 2024, in 2021, when I left my W-2, we had a good acquisition that year, but we were still just doing 50-50 deals with my partner and I. But then it's like, okay, we can't continue to grow if we have limitations on capital. We did have some refinances before rates went down. But honestly, at that time, I was just really assessing the return on not just money, but return on time and whether I wanted to self-manage or manage in-house and build a team. So we did a lot of passive deals. And what I would say there is those deals are going okay, but not great if you look at the timing of that. So Paul's distributions and other challenges. And I'm like, man, we can do this. And I think we can do this better. So I just tell people, if you have the willingness or desire to do it yourself, be willing to bet on yourself, invest in yourself and bet on yourself. You're going to get better returns if you do it on your own than if you just invest in someone else, and you're going to have more control over the situation. So we kind of went through that process and that cycle. And then in 2024 is when we started to bring in some private capital. And I think it's a nature of, we live in a small community, like, people know people and people knew I was in real estate. We also started a real estate meetup like 4 years ago, where if you're the facilitator of those, I think you gain some authority.
We say that all the time, that you literally just echoed, like when you're the guy who put it together, people look at you differently. So keep going.
Yeah. And I just facilitated discussions, right? And so all of a sudden, like I was mentoring someone who was at those real estate meetups in a 50 unit deal. He's like, hey, I can't do this on my own. Will you partner with me on this one? So we found a deal that way. So leading up to 2024, a lot of the stuff was 50-50 partnerships with some different folks. And then in 2024, the first deal we did, the deals we're looking at now, we might structure a little bit different, but we just kept it as simple as possible. So, we were confident it was going to have like a 5% or so cash on cash return. And we did low acquisition fees, low fees, straight 70-30 split. Just made it as simple as possible. So we didn't put a pref in. I hear a lot of people saying we won't do a deal unless there's a pref, and I completely get that. But I heard people say that if there's a pref involved and if the syndicators don't hit what's called a promote, where they're not making any money on it, they're much more incentivized to sell that thing in a year or two, and the interests aren't always aligned. So I see both sides of the story, but really I think my strategy is, with our investors who maybe haven't done other syndication stuff, keep it as simple as possible so they can understand, like, hey, return of capital, cash flow gets split 70-30, return of capital goes to you first, and then after that we split our profits 70-30.
That's our philosophy too. Is like, you can't explain how your investors make money within like 15 to 20 seconds, then it might be too complicated. And I think with the waterfalls, I think people have gotten kind of cute, almost to the point where like, well, I don't understand how this thing works. And either way, like you said, a lot of syndicators aren't doing great right now. And you also got to make sure, I always thought, make sure that if you're going to invest with somebody, or if you are also the sponsor, make sure that everybody's interests are aligned, right? Like some of these guys make all their money by taking acquisition fees and asset management fees, and that doesn't incent them to operate efficient deals.
We just looked at a 50-unit deal, and we're like, man, we could really, this would be a pretty easy one to run. We could just build our cash flow from this. I just see the temptation, look at that acquisition fee, but the deal doesn't work. And that's I think it's a dangerous game. Like that first one, we did like a 0.5% acquisition fee. I mean, ridiculously probably won't do that in the future. But it's a dangerous thing to get to. I think that's what happened the last couple of years, is people got really hooked on those acquisition fees. We want to make sure our management team is completely funded through our property management revenue. and that covers the team and the staffing, and we're not reliant on acquisition fees to be able to cover payroll. I think it's a dangerous game to play.
It's a great model if you play it right, but yeah, a lot of guys, they just threw out the fundamentals of real estate and they fuel their team the acquisition fees, but then when real estate gets expensive, interest rates go up, they're like, well, we need to keep closing things. And now you're controlling, you're basically you're funneling investors' money, LP money into bad deals and taking a piece of that. Like, it's immoral in a lot of ways. So
yeah, and a lot of people have gotten burnt from it, unfortunately.
Yeah. So real quick, like, I'm curious how, maybe talk about your wife, your family, how real estate's changed your life. Like, what does your day look like? I know you have 5 children, which demand your time, and that's important to you. And so maybe just talk about, some of that.
Yeah. So first of all, I think, again, you guys, your intro, I loved it, but it's so important to live a life, I think, in alignment with each other. So like an example I'll use is I have a clarity of purpose for different areas of life. So like health, to have energy for my kids and my grandkids and to live my purpose, right? And if my health purpose is just to look good, that's not very meaningful. But if it's to have energy for my kids and my grandkids and live my purpose, I'm going to be more healthy. So I just think, having clarity and alignment of your different areas of life so they support each other and are in alignment of each other is very important. And I think for real estate, I think that's particularly important to say, okay, if it's just, I want to be worth this much money or I want to have this much cash flow, but there's nothing more behind it, then I think that's not very motivating. I think those are fine metrics to target, but there needs to be something behind it. Like, I want to be able to make this much money so that my wife can quit my job, or so that I can quit my job because they want to spend more time with our kids, with our family. We want to travel more, whatever it might be. So I think getting clear on aligning your priorities and why, like, I think if you do that for real estate, you're going to have more conviction, which will give you the courage to take the action, which then has the snowball effect that we talked about earlier. So I think that's really important. So what do my days and weeks look like? First, I get up early, just do a little bit of silent prayer time. A lot of mornings I'll go on a walk with my wife, Marcia, depending on the weather in Ohio. That is not always, we will bundle up and it will be, we'll put like our ski gear on sometimes and take a walk, but not always, especially if it's like 0 and negative, whatever. It's too windy, then we don't do it. But, we try to do that most mornings. I'll come back, get my workout in. I have a sauna. I'll sit in a sauna for 15 minutes. Again, do more silent prayer, meditation. And by that time, I just feel like, man, I'm really energized and can conquer the day, get up, help with the kids a little bit. Maybe Marcia's awesome, so she has a lot of that under control. Put them on the bus, go to work. And then in the evenings, just, honestly, in the evenings, I am coaching as much as I can, and I am chasing kids around, whether that's going to their volleyball games, coaching baseball, softball, basketball, soccer, which I don't know a whole lot about, but just trying to be as active and engaged dad as I can be. And I'm human and I mess up and slip up plenty, but just trying to be purposeful and intentional about that as much as I can.
I love that. And I love, Phil, how, it's like if you have like 1 or 2 kids, then you're like, oh, my wife does a really good job with that. But when you have 5, you say, my wife has it under control. I wanted to go back to that because 5 kids that's got to be a fun, rambunctious crew. I mean, what's it like having 5 children?
I would say the attempt is controlled chaos. And I say the attempt because it can be chaotic. So our oldest is 14, our youngest is 5, 3 girls and 2 boys. Yeah, it can be bananas, man. I mean, we try to have structure and we'll try to like have conversations at the dinner table. And then, the 7-year-old boy makes a joke and it's, whatever. Like it can go anywhere in any direction at any time.
Always entertained though.
But I think I'll go back to like, the better I'm taking care of myself and living in alignment with what's important to me, I think the better husband and better father that I am because of that. And again, that comes with plenty of imperfections, but go back to the health, like just like the beginning of the episode or going back to health. If you have those things like right, you're going to be better at the other areas of life. That's why I like the word alignment and not balance. We're not trading things off for each other. If we're living in alignment, we're supporting different areas of life with each other.
I love it. You should basically be our 4th co-host. Because everything you're saying is, you talk about, we call it your burning why. Why do I get up every morning? Because it's not easy. I think that's another misconception that people have is that, they've been watching social media and talking heads that, are running to the bank to cash their checks and that was easy and moving on. Well, a lot of those guys maybe, aren't doing so great these days.
Right.
And it's not easy. Like managing those 25 single family houses wasn't easy. learning the ropes on multifamily and dealing with D-class tenants isn't easy. Dealing with some of the stress and isn't easy, but if you don't have a good burning why, you're going to throw the towel in. But if you have a why behind the why, I'm like, yeah, I absolutely want to live a long, healthy life. I want to have the freedoms to take my kids out of school for a couple weeks and travel the world. I want to spend that quality time with them. I want to spend time with my aging parents. Like those are really meaningful whys, and almost like you want to tie KPIs to those things, not my passive income is X and my net worth is Y. It's like, how many days can I take off in a day or in a week, in a year? That's a cool KPI to track as opposed to dollars in the bank account.
You started your podcast, a year or so ago, a little bit over a year ago, about the same time I started mine. And that's what people see. They don't see the prior 10, 12 years of grit and struggle and grind and arguments and disagreements and debates and what direction do we go. They don't understand. They didn't see all that. And they're like, oh, look at this. Like, and by the way, they also see our public, what we're trying to portray versus behind the scenes, like the mistakes we make. And I mean, at least I do. I don't know if you guys do, but
we try and share it to like, I invested with some guys that were bad eggs. I had to, say, bad properties. Like, yeah, we tried because I think we wouldn't be doing our audience or the people in our tribe, just like you wouldn't be doing the people in your sphere. You'd be doing them a disservice if it was all bunny, rainbows and butterflies.
And those mistakes and lessons are growth. Like you're not trying to make mistakes. We talked about, we're not trying to make mistakes, but we're framing opportunities as, okay, the upside is this works really well. The downside is it's a lesson that will help me in some other way anyway. So it's just having a growth mindset and how you frame things. The other thing I wanted to add that you said is, we put these KPIs and metrics around real estate, but not other things. And I think it's really important when we talk about clarity of purpose, how we're educating ourselves, how we're associating with others, the action we're taking, all those things. We need to have goals around how are we growing our mindset. So if that's education around, are we a better father, husband, person of faith, health? If we're only doing that in real estate and in not other areas of life, we're probably missing it and not living in alignment completely, right? So I think just having those, whether it's KPIs or goals in all areas of life, I think is important.
Sounds like a mastermind we're in called GoBundance, where, we track health, wealth. Are you in GoBundance, by the way?
I am. Yes.
Yeah. So I love that about GoBundance because it's not just how rich can you get. It's like, how can you be a great dad? Can you be philanthropic? Can you be healthy? Can you live your best life? And I love that you say not life balance, because I also think that's a misconception. I love that you say living in alignment. All kinds of cool stuff here. I mean, be a thought leader. That's where you find investors. I love that you said that. Even if you don't know what the heck you're talking about, if you're the one hosting a meetup, maybe with a light agenda and bring a guest speaker in.
Interview people, right? Just have a conversation with people, ask some questions.
Yeah, like we do here. Like we don't know all the answers, especially Mitch. But when we're hearing people, like we could be the thought leader. And I guess I have two. Mitch, I'll let you take the last question. I have one second to last question. What's the end goal for you, man? Like, Phil, are you going to get to 1 million units, or is it to get to a certain point and exit to a REIT, hold in cash flow, hand it down to your kids? I think that's something else people don't think about a lot. Like, what is the end game? What does that look like?
Yeah, we have a 10-year number, but I don't have that's not what's motivating me. I'm really looking for 3 things out of my business. So 3 things from my business I'm looking for. First, I want to inspire and educate others to live their God-given purpose. Second, I want to have a team that wins together and build a great culture around that. And third, I want to donate a lot of money. Those are the 3 things. And those things then cascade, and we have a strategy deployment process here. We use Traction or EOS, where those things cascade into what are we doing in the next 3 years, in the next 1 year, in 2025, in this quarter. And then we have a meeting each week that says, okay, based on what we're trying to do this quarter, what do we need to get done this week to move us towards that? So, we have numbers around that, but from a real estate perspective, we do have some deals that we will buy and flip, but generally speaking, especially if it's B class or better, we're long-term buy and hold. And we just want to kind of continue to build a portfolio, build a team, not crazy fast, but at a smart, steady pace that balances, the things I'm looking for there with financial growth as well. And if we do that stuff and we focus on that, the financials and the money, all that stuff will take care of itself.
Maybe have some fun along the way.
Travel, hang out with the kids, try to get some experiences, all that stuff too. Leave time for that. So that's important. We were just in Disney a couple weeks ago, and then we did spring training just with my 2 boys last week. So we try to have some fun as well.
So, Phil, if you've listened to our podcast, you know this question, but it's a hypothetical. You've lost everything, all the money, all the connections, so your network's gone. Unfortunately, we had to take that away. And you're sleeping on a buddy's couch. We also have to add that the buddy is not a smart buddy, because a lot of people are like, well, I'm going to ask my buddy and I'm going to ask for a loan. He's also broke. Okay. And it's not going to help you other than a roof over your head and a couch and a bag of top ramen, maybe. So the question though is like, how do you go build what you've built? Now, knowing what you know today, is there a different way you'd approach it? What does your first week look like? What does your first month look like? And the reason we ask this is there are people listening to our podcast who are there, who are like, look, I'm at zero. How could I go do this? So just curious what your approach is.
Yeah. So I did anticipate this question. I'd say the first thing I would do is really try to, at the time, as I'm trying to do as we speak here, but just really slow down and think and just like, what direction do I want to go? What do I really, really want? And make sure I get really crystal clear on that. And if what I wanted then was, okay, I want to build it back. I want to build up our financial lives back up. What would I do specifically would be network like crazy. If I had clarity of what I wanted, if I had the education, but not the network, I would network like crazy so I could take action on that. Networking would mean meeting with as many people. I would probably have to clean myself up, maybe find a shower, get a nice little suit. So I don't know.
Your buddy's in a shower. It's a dirty shower, but he's got a shower.
So I can at least leave the house looking decent. Then I'm going to network like crazy to find deals and find money. Those are the two things I need that I don't have. I don't have the network and money and deals. And I'm going to bring those two things together. And I'm going to try to just build trust with as many people I can through the things I talked about earlier. And I think, that would take a little bit of time, but if you have the clarity of what you want and the education and you build a network, you can do anything you want.
Last thing's find your who. Sometimes I love that earlier. You said like, I did not run multifamily. I found a fourth guy that knows how to do it. And that's what the network is. It's like, where can people fit into my life to add value? And where can I fit into their life to add value?
I love how you went further than that. You said, look, it's capital and deals. And when you can marry those up in the marketplace, then you unlock value for all stakeholders. I mean, that's the game we play.
Yeah.
Even today, it's like Travis and I will go find a property. Sometimes we go in on it. Sometimes we don't. And when we don't, it's like, or we roll very little, we're still putting together a multi-million-dollar deal and marrying up capital and then unlocking value. And then, so you don't have to have all the capital in the world if you have a great network.
Agreed. And I think that's the nature of why multifamily syndications, there's a lot of different partnership structures and people doing different things, right? There's people that are helping find money. There's people that are helping finding deals. There's people that are running deals, and there's a lot of value to be had there. There's a lot of gain from that, but also you can contribute and add value in a lot of different ways. So wherever you fit in that puzzle, find the other people that match up with you well.
100%.
Well said, Phil. Man, this has been a great podcast. Congratulations to all your success.
Yeah, I appreciate it. This was a ton of fun, guys. I love the jabbering, and I hope I could instigate a little of it, maybe mediate here and there too. But this is a lot of fun. You guys do great. A lot of alignment of I think beliefs and just mindset. So this was really cool to be a part of.